Markets have taken another hit. This time the news narrative is shifting towards energy stocks. It's shifting towards banking collapses. It's shifting towards big money sentiment. So what is actually going on? Let's take a look at what is happening in the macro markets, how this is affecting Bitcoin, and of course, smash up that like and subscribe button. Terrible segue, but I hope you are getting some value from these videos. Now, at the end, I'm also going to give you a major tip when it comes to these sorts of charts and the different narratives that continue to flip around time and time again throughout these markets. I want to leave that to the end so that we can get through the analysis first. The other thing, top of the video description, is our TIA premium. This is stuff we go through with our members once a week and in full detail on our weekly live streams. This stuff helps you get a clearer picture of the noise in the markets and put together the pieces of all of the cycles, the real estate cycle, stock market, and of course, cryptocurrency. So I'll leave that top of the video description. But for now, let's crack on with what is going on in the news and how the narratives shift. Now, this comes to my attention, which is a fantastic thing from you guys, all of you watching, because you're starting to pay attention to what the macro indicators are, what these macro indicators are trying to tell us. This was a particular one here on yesterday's video that mentioned to me that the smart money movements for S&P, there are charts for this. This isn't a guess, it's charts, etc. So that's where this is coming from, and I want to explain that towards the end of the video as we get through the analysis. So enough of the rambling. What is the first piece here before we get to that big money, or in the case of the comments saying the smart money? So the first piece is the energy sector stocks. Now, there's an easy way that news narratives can shift when they take a piece of data and decide which time frame they want to emphasize and put a big disclaimer or a big collapse setting or warning on, right? This time we're looking at the energy stocks, and the main thing here is that we're seeing new 1 month lows for energy stocks. So this is putting a fair bit of fear into the market, and people think, oh, this is just the beginning and the market needs to collapse further. As always, we want to have a look at the data and what this data point means. The important thing to note here is that it is just one data point, and you probably figured it out yourself. What the hell does this have to do with the entire market itself or even Bitcoin? We'll get to that in a moment. But essentially, with the data over the last 70 years, when the stocks in the energy sector close at 1 month lows exceeds 84%, so more than 84% of the stocks are closing at 1 month lows in 15 days or fewer of a 6-week high of the sector. So we had a high within 15 days, 80% are at new lows. What does this mean? Well, downside. More downside begets more downside. That's just the trend. 2 weeks later, the sector closed lower 7 out of 10 times. So it just means that the energy sector is going on a downtrend. But what does this mean longer term? Well, we can see from 3 months later, it's 7 out of 10 times it's up. So from 2 weeks later, it's down. This is the positive returns. So only 3 out of 10 are in positive and 7 out of 10 are in negative. And then we go to the 3 months later and it's flipped on its head. You've got 7 out of 10 in positive and 3 out of 10 are in negative. 6 months later, you're at 85%. And then 12 months later, you're at 67%. So eventually it all catches up. And I'll show you that in the chart itself. So this is the SP 500 Energy Sector, SPN if you want to search it yourself. There is cycles. So cycles in markets all across the board. That is what we as humans are made up of. The entire universe is made up of cycles. There's nothing we can do about it apart from learn what they are and see if we can get into tune with those cycles. So for the energy sector, it has been up for 32 months. I'm on a monthly chart here looking at the lows to the highs. Typically, we see 33 months, we see 70, we see 63. So there are some pretty significant numbers to the upside. We've got 32 at the moment. We had 33 in the past from this low to this high. And if you double these numbers, you get around 64, maybe 66, close to that 70 point. And we can always just move this to the next significant low and you got 64, basically the point before the market took off. So this is all of the energy sector. So maybe we've just gone through a half cycle of one of these major cycles. So what do we expect to the downside? Well, in the past, you got 19 bars, so that's 19 months. You've got 10 months, you've got 17 months. Where are we currently at? Well, we're about 6 months down. So 10 months from this point takes us out to about September. And we go 20 months out, that middle point takes us out to about July of 2024. So these are all macro cycles when it comes to the energy sector. And like the data showed, in a couple of weeks, the short term, which is what retail typically focuses on, or the new investor, I guess, or the news itself, yes, there's going to be more losses. But in the longer term, there's going to be more positivity in the gains. And that's just coming from the data here on the S&P, the S&P Energy, that is. As for oil, same sort of thing here. That's the major one that makes up this energy. And it's on a 2-month uptrend. It's had its uptrend into the Russia war. Now it has come back about 12 to 14 months, hitting on the 50% level. So these are all just cycles within cycles, looking at the short term, looking at the long term. And when we take these single data points, there is a very big area of failure in our own plans trying to make out what is actually going on. That's why I tend to stick with the same sort of things over and over again. The Gann swing indicator, the Gann 50% levels, and Wyckoff itself, looking at the volume and the tape reading of the chart. That's why I always go back to the facts in the charts. What is the money actually doing, not what the news headlines are pulling from particular data sets, whether it's short term, medium term, or long term. You've got to understand which time frame we're on. So there's part of your trading and investing tip for this video. Now, over to this particular comment here, which I've seen a lot of, which is a good thing. Okay, so hit up that like and subscribe, get down in the comment section. I usually have a good comment down there as well. So we're starting to make this a little bit more interactive. We've got a lot of learning in here, what's coming next, so that we can decipher through the noise in the market. And then you guys let me know in the comments section what you think is going on next. But in terms of this particular news piece, this next news narrative, when it comes to the big money sentiment stays low, meaning there is the big money getting out of this. They are unsure of what's happening next. The big money isn't buying the rally. The big money isn't betting on a bull market. And this typically comes through here as well, showing that smart money movement for S&P, they're all getting out at the moment. Maybe so, but they have called this wrong so many times. And so it's not necessarily that the big money always gets it right, because at the end of the day, the big money is taking money from the other big money. They don't need the small money, they're looking for big money. And there's a difference between big money and smart money. So that's where we have smart and dumb. The dumb money usually goes to the smart, and that can be between the big money and the big money as well. They're playing in the billions, hundreds of billions, tens of billions, maybe hundreds of millions, right? That's not what retail is playing in. But there is going to be dumb money in big money and smart money in big money as well. So although big money sentiment is staying low, it doesn't necessarily mean that the market is going to collapse. Overall, there was a moderate bullish tilt to the S&P's forward returns after a pessimistic sentiment from this group. So overall, 12 out of 15 times, it was completely wrong. There were a couple of significant losses, so they got those right. So it's not the worst indicator that we've ever come across on the channel here, but again, it's still not something to live by. Just like the rest of these data sets, it's not that you can use one particular data set to help you forward. You need a consistent, full, structured plan around something like a swing chart to let you know trend direction, something like volume to let you know what the money is actually doing, something like a 50% level to give you an idea of where profit targets are and extreme levels are in the market. So back to looking at this big money sentiment, the back testing, the data points here, this is the spread between the bulls and the bears when it's at its lowest levels, and what happens moving forward across the next week later, or the 1 month later, or even the 1 year later. So 1 week later, when this is at its most extreme, you can see it's about a 50-50 split. So nothing that you can really work with. But as you get further into the time zone, the time frames here, 2 months, 3 months, 6 months, 12 months, in particular, your 2 months, your 6 months, and your 12 months, you can see that there is an upwards tilt to the S&P. And that's pretty much the history of the stock markets. They tend to go up. So it's just a matter of the timing. And if we look at the timing, when these particular data points have come out, this has been near the peak. So that's a good one there. There was also the peak here in around 2019 before we had the pandemic collapse. There were several more months to the upside, but nonetheless, they're big money. They need to start to sell out before the exact peak. So can't hold it against them there. But then you had these times here just before the market peaked. So not a bad call, but then you got bad ones here, way at the bottom, bad ones here, way at the bottom, More bad ones here, way at the bottom. So this is 2 of them. Another one here as the market's heading up. It's at the bottom. You've got a long time to go before any sort of significant collapse. And again, in the middle of the run here, 2005, where you still have another couple of years left. And so it's not the most perfect indicator, but I have to say it's not the worst indicator that we've seen on the channel either. Other measures suggesting large trader hesitancy. So large investors aren't too keen on stocks. Taking a quick look at the major index combined hedger position. This is basically the combined dollar value of hedger positions in the S&P, the NASDAQ, and the Dow Jones. So all of the futures markets here in the US. So anything above the green line is pessimistic. It's the opposite, okay? When you think of green and red. Anything underneath the red is excessive optimism, as it says down here for the extreme values. So above, extreme pessimism. They've been pessimistic at the lows. And underneath, as you can see right here, they've been extremely optimistic. That is at the tops. So it's almost in complete opposite. Anytime you go back through this chart, you can see that there is extreme pessimism at the bottoms. Then you have extreme optimism as the market is trending up. So this continues to head further and further into pessimism, which potentially over the course of the next few months to a year is going to lead the S&P to higher prices. Just like we see with the other data and what we've been covering, typically this backtesting shows over the first few weeks, you don't really get a clear reading, but as time goes on, you get a much better reading and you start to see that these gains are to the upside. So keep that in mind if you're ever looking at these data points. It's not the next day or week or month. Typically, it's several months to maybe a year or two. So that's what we're seeing on the S&P right now, just range trading between the levels that we've been looking at around 4,000, 4,060 to these highs here at around 4,200 points. So the question now is this week going to close out lower or higher? The main thing that we need to focus on is it going to close above 4,000, which is this 50% level right here. Now we've got the banking crisis low well and truly down here at 38.40, so that's still intact, and the higher lows continue to form. So for now, nothing too much has changed. Yes, they are selling at the top, but the lows continue to get higher. So let's take a longer term perspective here and keep our heads about us when any of these short-term news items come up, like the regional bank sector collapsing. So I put this on Twitter. If you're not following, go and check that out down below. Links are all here for my official socials. Don't get scammed out there from those fake accounts across Instagram, Twitter, YouTube, Telegram, wherever it is. These are my only official links right here. So the regional banks were collapsing. That was the news. That was a narrative yesterday. Today we see the smart money, big money, saying that they're, well, at least the data showing that they're selling off. We're also getting the energy sector stuff, which if it comes through, it does. If not, you're in front. You get the idea of what's going on over there for the energy sector itself. In terms of the regional banks, I would say that this is very similar to what we saw in crypto when the SEC went after those other crypto exchanges that no one had ever heard of. Bitlatso comes to mind, Bixy, B-E-A-X-Y. It's the same thing, except now it's for regional banks. No one's even heard of these regional banks. If I have a link to it somewhere, here we go, PAC or PAC West. There were all these banks here, Western, Metropolitan. It was just like it was a complete shit show and everyone was freaking out about this. But it's the same thing over and over again. It's the same narrative. I guess that's why I have that tone in my voice where it's like the same thing we see time and time again, and it's history and we just don't learn from it, and people get scared about the same things, or they say, don't you know this is happening? And you're like, look, it's happened so many times before. And then if you go to the chart, the downsides are getting less and less. Here's your banking collapse, and now here is your regional collapse. It's next to nothing in comparison to what we saw over the inflation fears and the interest rates as we covered in yesterday's video. So you got everyone on social media going on about this, regional banks failing, and it's so important, and they're all the same, regionals the same as the big banks. No, they're not. All these things can go down, and JP Morgan, that has nearly 4 trillion in assets under management, is still bigger than all of those banks. So it doesn't matter. It really does not matter. And that's why I say it's basically laughable, because we've seen it so many times before. Forget the noise. Focus on the macro cycle. It still remains bullish until we see some of those indicators drop, and we will see some of those indicators turn like we do at the end of every cycle. So just as a reminder here, we're somewhere in this zone at the moment before we get to this really fast winner's curse stage where everything starts to go a little crazy and before the major collapse. And someone asked, where are we at in the major collapse? What happens in the major collapse? It's approximately 4 years, maybe about 6 years. This is for the real estate cycle, of course. For the stock market, you might get a nice spike down and a nice spike up in a matter of 2 years, like what has happened in the past. But we don't know yet. Let's wait till we get to the peak first, which is why we need to stay very vigilant right now, because we are coming towards the end of this and there will be some sort of very significant collapse. Not just what we've seen over 2022, which seems quite significant, but I think things are going to get a lot worse after we see some sort of bull market. This is for the stocks, this is for crypto, Bitcoin, and real estate. I'm not a perma bull. I'm a bull while the markets stay up and while the cycle is still up. We are going to get a very big collapse going forward, but we still have a few years left in this particular cycle. And as for Bitcoin, we can see that the cycle has really just begun. I do understand that there are still many people calling for a lot further downside to break past the 15K low, but that's pretty much all but gone. So that's the missed hope, the missed opportunity, as I've pointed out before, especially under around that $22,000 or $19,500 level. We've been up for several months. We're going to need some sort of plateau time soon, but we may start to form something like we did in 2015, 2016, where we got a bit of a breakout and then sideways for several months and another breakout and sideways for several months. This is going to put a lot of pressure on those bears where they're hoping and expecting further downside. So they keep the narrative rolling over, waiting till the end of the year, waiting till something else, because essentially they would say, well, my bearish narrative hasn't been invalidated yet, and they're just going to keep pushing that higher and higher. But eventually we'll get to the double top and they'll potentially say, well, here comes the bearish narrative. It could happen, but in the meantime, going from 15K to past $60,000 is 4 times your money. So it just depends on which camp you want to be in, on which time frame. For now, the trend is up. The monthlies are up, the monthly swings have been broken, and it seems like anything underneath approximately 19,500 to 22,000 is most likely a missed opportunity from the bears. That's a current look at the narratives that we have been seeing over the last 24 hours. Things seem like they're now shifting to the energy space, just after they went from the smart money, big money, whatever the headlines are at the time, moving towards the regional US banks. There's always something new. There's always a new narrative. But if we keep a broader picture, a macro view with our indicators, some nice simple stuff like we teach at TIA Premium, links of course are in the top of that video description, then you can start to reduce that noise and become a macro investor, along with potentially a short-term trader as well, to bring in those profits and know where to put them longer term. I'll leave it there. After you hit that like and subscribe, check out the comments down below and let me know your thoughts as well. Until the next one, take care and peace out.